capital adequacy is all about the Reserve Bank telling banks that they're nervous and that they think that in tough times or in a recession or even a depression, that the amount of capital that they're currently holding on their balance sheets could be insufficient to be able to weather a major economic crisis like we saw during the GFC. So Adrian Orr is out there pushing the fact that we need this. The Reserve Bank wants X amount of capital being held. The banks are obviously pushing back against that and saying, hey, we don't think that's necessarily appropriate. And it's not just the amount, it's maybe some of the other regulations around it. So is it going to happen? Look, I don't know. That was the question that people have asked me for years about capital gains tax. And I said, look, it's inevitable that it could happen. And I've been speaking on property since 2000, and well, seems like forever. But the point being that, hey, capital adequacy could happen. And I think everybody's sensing that something might happen. But look what Jacinda did and yanked capital gains tax at the last minute. Might. But let's just talk about what could happen if it did come through. First of all, how much capital is going to need to be held? Well, at the moment it's a conversation, and Adrian Orr is saying, look, I'm really interested in feedback, and I'm really open to having conversations about what people think about our proposal. So we're not there yet. If it does happen, it's going to be later in the year. How much capital do they need to put on, and what will that result in terms of the cost to the bank? Well, the cost to the bank all depends on how much goes on, so we don't yet know that. What we do know, or what I'm being told as I talk to various banks and some senior people in the banks, is that they are preparing to go out to the market to do a capital raise. And if they do that, that'll be a one-time thing, so it's not like there's going to be banks out raising capital forever and a day at a higher rate. So if they do that, it's a one-off thing, and then arguably, obviously, it does impact their cost base because they've got to pay interest on that money. So that will probably flow through. Any excuse for a bank to up interest rates and improve their margin. Of course, what we're probably never going to see is their cost analysis. So they're not going to come out and show us their spreadsheet of what additional cost this is adding to their cost base and how many basis points that they need to increase interest rates by. So if their cost base increases by 30 basis points as a result of going out and raising this capital, will they simply pass on those 30 basis points, or will they use the opportunity to maybe nudge rates up by another 20 basis points that goes to 50 basis points and interest rates rise by 50 basis points? Don't know. Or will it be a competitive environment where the Aussie banks finally realise that they need to loosen up on servicing requirements, and New Zealand banks are just subsidiaries of Aussie banks, and so that allows the New Zealand banks to loosen up and lend more money to property owners, and all of a sudden they're saying, yippee, we've got a whole bunch more money to lend to you, and we're no longer using 7.5% as the hurdle rate in the serviceability calculation, and in fact, and doing that on a P&I basis, principal and interest. In fact, now we can use 6% and it's back to interest only. So good times, and all of a sudden more people can borrow. And so is it that all of a sudden Westpac decides that, hey, we want to go back out, we like mortgages again, and we want to get back out and grow market share, in which case they might get competitive around interest rates. So it may be that they say, well, our cost base has increased by 30 basis points, but actually we want to grab more market share, so it's going to be 20 basis points. So all of that conversation, I guess, could be seen as a little bit of a storm in a teacup, because the thing is that I can't see how a cost base would necessarily increase by a whole percentage point. I could be wrong. I'm not an analyst at the BNZ or Westpac or ANZ or any of the other banks. So we don't really know. My sense is that this is probably not talking about how many percentage points, we're going to be talking about basis points. So if we step back from that and we say, well, at the moment you can get rates that are sub 4% for a period of time, and everything else is sort of in that 4 to 5 percentage range, we're still not talking about, I can't see how we could be seeing interest rates going to 8%. Couple that up with the fact that historically interest rates have sat below 5%. And when I'm talking about historically, I'm talking over a period of hundreds of years. we know from research and different statistics that interest rate spikes over a period of time are usually, or appear to be, really closely correlated to massive population growth spikes. But now we're into a period where the world population is still growing, but that growth rate is declining. So if we believe the correlation between interest rates and population growth, then you'd have to say that all other things being equal, we're probably going to be looking at interest rates remaining sub 5%. We have just seen the Reserve Bank in New Zealand more recently cut the OCR by 25 basis points, and there could be a further 25 basis point cut as well. So put all of that together, and I'd say capital adequacy is there. I don't want the banks to increase rates. Well, none of us do. But I'm also not seeing it as a massive inhibitor to investing in property and thinking I need to pause because, oh my goodness, what could happen with interest rates? Quite the contrary. I'm expecting that eventually that the banks will get a little bit more flexible with their serviceability criteria. When that happens, we're going to see a lot more people willing to buy. We know that there's other people coming into the marketplace, non-banks trying to offer borrowings. So I expect that to happen one way or another over the next 2 to 3 years. And then we'll see demand growing, and that's probably when we'll see prices starting to lift again. In the meantime, what I'm trying to do and practice what I preach is get out there and keep building my portfolio so when the next boom comes, I'm ready for that growth and I can experience as much capital gain as possible.